Hello investors and traders. This video will explain the volume-based technical indicator money flow index, MFI. Money flow index is a movement indicator that analyzes both time and price to measure the trading pressure, buying or selling. It is also called volume-weighted relative strength index, RSI, as it includes volume, unlike RSI, which only incorporates price. Positive money flow is indicated by an increase in typical price signaling buying pressure, whereas a decrease in typical price indicates a negative money flow, thus signaling a selling pressure. These positive and negative money flows are accumulated to create a money flow ratio or a money ratio. The money ratio is used to find out the MFI that oscillates between 0 and 100. As the MFI incorporates volume, it can be used for identification of price extreme reversal with diverse signals. What is the money flow index, MFI? The money flow index is a technical oscillator that uses price and volume data for identifying overbought or oversold signals in an asset. It can be used to spot the divergences which warn of a trend change in price. The oscillator moves between 0 and 100. Unlike conventional oscillators such as relative strength index, RSI, the money flow index incorporates both price and volume data as opposed to just price. For this reason, some analysts call MFI the volume-weighted RSI. Some key takeaways before we get started. The money flow index is a technical indicator that generates overbought or oversold signals using both prices and volume data. An MFI reading above 80 is considered overbought, and MFI reading below 20 is considered oversold. Although levels of 90 and 10 are also used as thresholds. A divergence between the indicated price is noteworthy. For example, if the indicator is rising while the price is falling flat, the price could start rising. MFI is a volume-based indicator. It allows the assessment of divergences between price movement and volume flow. It is also important to change some of the assessments inside the formula. The usual is 14 is the number. I've seen with 5 and 8 also can help out a lot. So for the shorter term, you use 5. For the intermediate term, 7. And for the longer term, you could use 14. This is one of the key successes to the MFI is by changing the formula inside there. Just the number, 14, 5, 7, depending on what kind of trader you are, long-term, intermediate term, or short-term. What does the money flow index tell you? The overbought and oversold levels are used to signal possible trading opportunity. Moves below 10 and above 90 are rare. Traders watch for the MFI to move back 10 to signal a long trade and to drop below 90 to signal a short trade. This can all change by changing the number. This is the default is 14. Other moves out of the overbought, oversold territory can be used for example, when an asset is in an uptrend, a drop below 20 or even 30 and then rally back above, it could indicate a pullback is over and the price uptrend is resuming. The same goes for a downtrend. A short-term rally could push the MFI up to 70 or 80, but when it drops below, that could be the time to enter a short trade in preparation for another drop. One of the primary ways to use the money flow index is when there is a divergence. A divergence is when an oscillator is moving in the opposite direction of a price. This is a signal of a potential reversal in the prevailing price trend. For example, a very high money flow index that begins to fall below a reading of 80 while the underlying security continues to climb, price reversal signals to the downside. Conversely, a very low MFI reading climbs above a reading 20 while the underlying security continues to sell off is a price reversal signal to the upside. Traders also watch for larger divergences using multiple waves in the price and MFI. For example, a stock price at 10 pulls back to 8 and then rallies to 12. The price has made two successive highs at 10 and 12. If MFI makes a lower high when the price reaches 12, the indicator is not confirming the new high. This could foreshadow a decline in price. The difference between the money flow index and the relative strength RSI. The MFI and RSI are very closely related. The main difference is MFI incorporates volume while the RSI does not. Proponents of volume analysis is a leading indicator. Therefore, they also believe the MFI will provide signals and warn of possible reversals in more timely fashion than the RSI. One indicator is not better than the other. They are simply incorporating different elements and will therefore provide signals at different times. Limitations of the money flow index. The MFI is capable of producing false signals. This is when the indicator does something that indicates a good trading opportunity is present, but then the price doesn't move as expected, resulting in a losing trade. A divergence may not result in a price reversal, for instance. The indicator may also fail to warn of something important. For example, while a divergence may result in a price reversing some of the time, divergence won't be present for all price reversals. Because of this, it is recommended that traders use other forms of analysis and risk control and not rely exclusively on one indicator. It is not necessary to know the calculations, but you should know the basics. Formula for the money flow index MFI. Money flow index MFI can be calculated by using the following steps. Compute the typical price for a period. Typical price equal low plus high plus close divided by 3. If the typical price for today is higher than yesterday, it implies a positive money flow. If the typical price is lower, it implies a negative money flow. The aggregate of positive money flow over certain periods gives positive money flow, and the aggregate negative money over a certain period gives negative money flow. Compute the raw money flow. Raw money flow equals volume times typical price. Compute the money ratio. Money ratio equal 14 period positive money flow divided by 14 period negative money flow. Compute the money flow index MFI. Money flow index MFI equal 100 minus 100 divided by parentheses 1 plus the money ratio close parentheses. Money flow index MFI signals. MFI generates 3 main signals: overbought, oversold conditionals, failure swings, and divergences. F is a good indicator, but one indicator does not make a system. The MFI should be combined with other indicators to make a system and use a weight of evidence. So again, MFI is a volume-based indicator that allows the assessment of divergences between price movements and volume flow. It specifically is combining volume and relative strength together to give you a number between 0 and 100. By changing the parameters, which is the usual default is 14, you will get faster moving signals the lower the number. I use 5 for shorter term, 7 for intermediate term, and the longer the 14. So use the MFI inside your system and remember the catchphrase: study it, analyze it, adapt it. Peace.